Okay, let's unpack this. Welcome to the deep dive, where our mission is to cut through the noise.
Yeah, get right to the essential insights.
Exactly. From today's crucial financial shifts, we're diving deep into market movements, those subtle whispers shaping Fed policy.
And some really impactful government legislation, too.
Right. Think of our sources today as your, express pass to being really well informed on these complex, fast-moving topics.
And what's truly fascinating here, as we start connecting the dots,
Hmm.
is that intricate dance, between investor sentiment, the anticipation of potential policy changes, like right from the top,
Okay.
and then how individual companies are actually navigating all this.
Navigating this shifting landscape.
Yeah. So this deep dive, it's not just reporting facts. We want to reveal some maybe surprising connections.
And hopefully offer you some genuinely practical insight.
Exactly. How these forces are playing out right now.
So let's kick things off, a snapshot of the immediate market pulse.
Let's do it.
As we're recording, U.S. stock futures Dow, S&P 500, NASDAQ, they're all showing solid gains.
Okay, positive start in the U.S.
Yeah, and the S&P 500 is actually flirting with its all-time closing high. It's less than 1% away.
Wow, really close.
But, this isn't a universally shared vibe globally.
Right. How's it looking elsewhere?
Well, most Asian markets actually ended in the red.
Okay.
And while Europe saw some modest upticks, Japan's Nikkei 225 was a notable exception. It was up over 1.6%.
Interesting. So definitely a mixed bag outside the U.S. picture.
Definitely.
So if we try and connect this to the bigger picture, what's the main engine here driving this positive feeling in U.S. futures?
Yeah, what's the source saying?
Well, it seems it's not necessarily a concrete policy change yet.
Okay, not something definite then.
No, more like renewed speculation. Our sources highlight this increased buzz,
Buzz about.
a potential shift in Federal Reserve leadership towards a more dovish stance.
Ah, dovish.
Yeah.
So favoring lower interest rates, more accommodation.
Exactly. Aimed at stimulating growth. The chatter suggests President Trump might be considering naming a successor to Fed Chair Jerome Powell. Well, sooner than anticipated.
And the market likes that idea.
Yeah, it fuels expectations of earlier interest rate cuts. We're even seeing some Fed policymakers, including some Trump appointees, indicating they'd consider a July rate cut, which is quite different from Powell's current sort of wait-and-see approach.
That is a contrast.
Oh, and it's probably worth a quick mention, too, easing geopolitical tensions, like the recent Israel-Iran ceasefire. That's likely adding a bit to the positive mood as well.
It's just striking, isn't it, how much these markets hang on every whisper, every potential shift.
Yeah, before anything concrete even happens.
It really shows how sentiment drives it's almost like a self-fulfilling prophecy until, proven otherwise.
Absolutely.
So here's a thought. If the market is already pricing in these dovish bets, what happens if the Fed doesn't deliver? Is there a big risk of a, sell the news event?
That's a really critical question. The market's hypersensitivity, it means it's reacting to the anticipation, not just the policy itself.
Right.
So if those expectations for earlier cuts get dashed, or if Powell holds firm on inflation, yeah, we could absolutely see a sharp reversal.
A feedback loop.
It's a powerful one. Whispers shaping billions, long before any vote is cast. It's not just economics, it's deep into the psychology of expectation.
That's a perfect lead-in, actually, to some of the individual company stories moving the needle.
Okay, who's making moves?
Well, NVIDIA, ticker NVDA, just continues its relentless performance, trading higher in pre-market.
Still going strong.
It hit a new all-time high yesterday, $154.31.
Right.
Get this. Some analysts are putting out a bold new price target of $250.
$250, wow. The AI infrastructure story.
It's like the AI gold rush. And NVDA is selling the picks and shovels. Microsoft, MSFT also hit new highs, ticking higher, really competing with NVIDIA for that top spot, world's most valuable company.
That race is fascinating.
And Micron Technology, MU, also surged. Strong earnings, revenue beat estimates, again, clearly riding that booming AI demand wave.
So AI is just dominating these gainers.
Seems like it. We also saw Coinbase Global, Coin, up.
Okay.
Meta shares climbed, apparently after poaching some key OpenAI researchers.
The talent war in AI continues. That's a big signal.
Yeah. H.B. Fuller rose after raising its outlook. Worthington Steel, WS, got a bump from strong earnings.
Good signs there.
And Vor Biopharma, VOR, had a massive pre-market surge. Over 100% at one point.
What was behind that?
A significant licensing deal. Even Tesla, TSLA, managed a slight gain.
Interesting, considering they sold fewer vehicles in May.
Right. Now, on the flip side, what about the decliners? Any notable ones?
Yeah, we had a few. Kratos Defense and Security Solutions, KTOS, its stock declined after a stock offering plan.
Dilution concerns often happens.
Exactly. Jefferies Financial, JEEF, shares fell after reporting earnings, and Paychex, PAYS, was also down after its earnings report.
So a mix of reasons there.
Yeah, it really illustrates how company-specific news, good performance, strategic moves like that licensing deal, or even financing activities plays out against the broader market.
Yeah.
Sometimes it swims against the macro tide, you know?
Absolutely. And here's where it gets really interesting for the economy overall, because it's not all just smooth sailing upwards.
Okay, what are the cross currents?
We've seen Treasury yields decline. That usually suggests bond investors are anticipating maybe slower growth or lower rates, while oil prices have edged higher, signs of firm U.S. demand there.
Okay, conflicting signals almost.
Kind of, but beneath that, our sources point to these lingering inflation concerns.
Inflation again.
Yeah, Fed Chair Powell has reiterated a cautious stance on rate cuts. He specifically cited the risk of persistent inflation because of potential tariffs.
Well, the tariff impact.
And analysts are genuinely concerned that these tariffs, plus ongoing geopolitical conflicts, could lead to higher prices and slower growth.
That combination, that's precisely what experts worry could potentially spur something called stagflation.
Stagflation, high inflation, sluggish growth. Not a great mix.
Definitely not. So this raises a really important question. What does this delicate balance, or maybe imbalance, mean for company profits and for the overall market valuation, which, according to our sources, already looks quite high?
Yeah, potentially vulnerable to negative surprises.
Could be. It's a complex dynamic. Could really reshape how we think about future earnings.
Okay, shifting gears a bit. Let's talk government policy. Always plays a huge role in the economic story.
Absolutely. What are the sources highlighting?
They introduce us to what's being called President Trump's One Big Beautiful Bill, also known as the One Big Beautiful Bill Act.
Okay, I've heard buzz about that. Passed the House, right?
Correct. Passed the House, now awaiting Senate consideration.
So what's in it? What are the key arguments, the provisions, according to the sources?
Well, it proposes what proponents are touting as the largest tax cuts in history.
Largest ever, okay.
With claimed benefits aimed specifically at families, small businesses, farmers, and seniors.
Any specific measures mentioned?
Yeah, things like eliminating taxes on tips and overtime, tax deductions for buying American-made cars, making the 2017 Trump tax cuts permanent.
Okay, extending those.
And expanding the guaranteed standard deduction. Supporters estimate these changes could lead to quite significant increases in take-home pay and wages for a lot of people.
There's significant claims on pay increase.
But it doesn't stop at tax cuts, does it?
Doesn't sound like it. The bill also aims for substantial deficit reduction, claiming $1.6 trillion in savings.
$1.6 trillion. Well, it also seeks to curb government spending. Plus, it allocates significant resources for border security funding for physical barriers, increased pay for border agents.
Okay, spending cuts and border funding.
On healthcare, it states its intention is to strengthen and protect Medicaid. And it seeks to reverse current administration policies to, quote, unleash American energy production.
Unleash energy production.
Right. And, quite interestingly, includes provisions for something called Trump savings accounts for newborns.
Trump savings accounts. That's a new one. It's certainly a sweeping set of proposals.
It really is.
You mentioned significant deficit reduction claims for this bill. How do those claims generally hold up under economic scrutiny? Or what are the common counter-arguments you hear from other financial perspectives on the actual long-term impact of such big tax cuts on the deficit? It's always a point of debate, isn't it?
It's a huge point of debate. While the bill's proponents, they highlight the projected savings and the economic stimulus effects.
All right, the growth argument.
Exactly. Other analyses often raise concerns about the long-term impact of such extensive tax cuts on the national debt, especially if that promised economic growth doesn't quite materialize as quickly or strongly as anticipated.
So it comes down to that supply side versus fiscal sustainability argument again.
Pretty much. Does growth pay for the cuts or not? It really makes you wonder how such an ambitious bill, focusing on stimulus and claimed fiscal responsibility, might interact with the Fed's monetary policy decisions.
Yeah, and that market sentiment we were just talking about.
It's a massive puzzle, so many interconnected pieces.
Definitely.
Now let's try and connect this deep dive knowledge to potential actions. For you, the listener, constantly looking for those aha moments about market opportunity.
How to translate understanding into strategy.
Right. Understanding these dynamics isn't just about being informed, it's about seeing how these forces can translate into strategic plays. And our sources suggest specific option spread strategies that traders are actually considering right now to navigate these very dynamics.
Okay, let's get practical. What are we looking at?
Where do we start?
Well, given the current environment, generally bullish market, but with those underlying concerns and specific company moves, here are a few structured approaches traders might consider.
Okay.
First, maybe a bull call spread on those strong-performing tech or growth stocks we mentioned, like NVIDIA, Coinbase, Micron, Meta.
Okay, a bull call spread. So for when you think a stock will go up, but maybe not, like explode higher.
Exactly. You anticipate a moderate rise in something already showing strong upward momentum. You're betting on continued upside, but you're also managing your risk and capping your potential profit.
So someone thinks NVIDIA's got more room to run, but maybe not another 50% overnight. This lets them participate without taking on unlimited risk, like a defined bet.
Precisely. You create a profit window. So as a hypothetical for NVIDIA, around $154 currently,
Yeah.
you might buy a call option slightly in the money, say the $150 strike,
Okay, buy the $150 call.
and then simultaneously sell a call option further out of the money, maybe the $160 strike, both with the same expiry date, perhaps July 19th.
Got it. Buy the 150, sell the 160, July expiry.
Your maximum profit is capped, is the difference in strikes minus the net cost of the spread.
Yeah.
And your maximum loss is limited just to that net premium you pay. It's a measured bullish play.
Okay. Makes sense. What about if you're looking at a sector that seems to be lagging behind?
Good question. For that, you could consider a bear put spread on a lagging sector ETF, something like XRT, the S&P Retail ETF.
Ah, retail. Sources mentioned consumer sectors lagging.
Exactly. So this strategy suits if you anticipate a moderate decline in those kinds of underlying assets. You buy a put option slightly in the money
Buying put.
and sell another put option further out of the money. Again, same expiry, maybe August 16th for XRT in this case.
So you profit if the ETF falls, but again, both profit and loss are limited.
Correct. You're capitalizing on potential weakness in areas, maybe not joining the broader rally, but still with defined risk. You're not betting the farm on a collapse, just a measured move down.
Got it. And what about for the broad market itself, like the S&P 500?
Right. For an index like the SPY, the S&P 500 ETF, if you anticipate the market might stay within a defined range after, say, an initial surge.
Or if volatility's high and you think it might come down.
Exactly. Then an iron condor can be quite versatile. It basically combines both a bear call spread and a bull put spread, both out of the money.
Okay, that sounds more complex. An iron condor tries to profit from the market not moving too much. Sideways action.
That's the idea. For SPY, let's say it's around $602.50. You could simultaneously sell a call option, maybe at $610, and buy one further out at $615.
Okay, that's the bear call spread part, betting it stays below 610.
Right. And at the same time, you sell a put option below the market, say $595, and buy one further down at $590.
And that's the bull put spread, betting it stays above 595.
Exactly. All for the same expiry, maybe July 19th again. You collect premium from selling both the call and the put spreads.
And you profit if SPY stays between those sold strikes, 595 and 610.
Correct. Your maximum profit is the net premium collected, and your maximum loss is also limited. It offers a defined risk-reward, especially appealing, like you said, when volatility is high and you expect it to calm down.
What really stands out to me about these structured approaches is that emphasis on defined risk seems key.
It absolutely is.
But of course, it's crucial to consider important factors before jumping into any strategy like this. What should listeners absolutely keep in mind?
Great point. For any option spread play, always check implied volatility.
Okay, IFAs. High FAV, good for selling premium. Low IV, cheaper for buying.
Precisely. Understand time decay, theta. If you're a net seller of premium, time decay is your friend, as options lose value closer to expiry.
Right.
Crucially, know your risk tolerance. What's the maximum potential loss? Know that before you enter the trade.
Non-negotiable.
Ensure liquidity. Can you get in and out of the options easily? Closely monitor the underlying movement of the stock or ETF. Things can change fast.
Absolutely.
And finally, don't forget brokerage commissions. Especially on multi-leg strategies, those can add up and impact your actual profit.
Good reminder.
It all just underscores the importance for you, the listener, to do your own thorough research. Really understand the strategy and the risks before making any investment decisions.
Definitely. So we've covered a lot. We navigated the immediate market landscape driven by that Fed speculation,
Dived into key company performances, the high flyers, few decliners.
explored the potential impact of major legislative efforts, like that one big beautiful bill.
And then tied it all back to specific option strategies for navigating these dynamics.
It's really clear how interconnected all these elements are, isn't it? Offers a much richer understanding of what actually moves the markets.
Absolutely. And for you, the learner, I think the key takeaway is how these seemingly disparate pieces of information from, presidential thoughts on the Fed
Yeah.
to specific company earnings to broad legislative proposals, how they all converge to shape market dynamics.
Yeah.
It's rarely just one thing,
Never just one thing.
which raises an important question for all of us, really. How will these dovish bets and these ambitious legislative goals ultimately reconcile with those persistent inflation concerns and the high market valuations we talked about?
Yeah. How does it all shake out long term?
What new opportunities or, what new challenges might that present as these stories continue to unfold? There's always more to learn, always more to watch.